Welcome to this week's market draw. We'll begin with the S&P 500, which is down 3.1% for the week. It is now down 1.9% year to date. Nasdaq was down even more, down 3.5% for the week. Nasdaq's down now 5.8% for the year, as the technology sector has really been the one kind of dragging the overall market, and Nasdaq tends to be much more tech focused than the S&P 500. Interestingly enough, the MSCI EFA, which is developed countries ex-US, were up 3.5% for the week. The EFI is now up 10.9% year to date. MSCI EM, emerging markets, is also up for the year. It's up 5.5% for the year. So if anything, what we've seen is in the US, rotation from kind of the more growth-oriented sectors like tech into more defensive sectors here in the US. And then we've also seen a rotation from domestic US equities to international, right? And it's a reminder of why being globally diversified is important, right? You will have times where international actually outperform by a fair bit that the US market. We just haven't seen it in a long time, but it's kind of playing out this year. So what's happening here in the US that's dragging stocks? The biggest reason here is ongoing uncertainty around trade policy, right? On Tuesday, marked the deadline for President Trump previously announced tariffs on Canada, Mexico, and Chinese imports. The administration did create some exceptions and delays for the tariffs, but nonetheless, there's just still a lot of uncertainty around it. And it's not surprising that the market's trying to kind of figure this out and it has such a big effect. JP Morgan had a really good chart in their guide to the markets that showed that when you look at tariffs on US goods imports for consumption, the proposed tariffs would signify roughly 18% of imports for consumption here in the United States. That roughly puts it at the level of tariffs we saw here in the 1930s in the United States. Consumption is almost 70% of what constitutes GDP. So it's not surprising that if we see these tariffs, we probably will see consumption fall off significantly. That's shown already in some of the data, and obviously why the markets are concerned, right? If we face a recession, that most likely would affect corporate America and earnings. And we started to see that on the earnings picture as well. When we look at the fourth quarter 2024 S&P earnings, they came in at about 18% year over year growth. It's one of the strongest quarters actually since 2021. But when we look at first quarter expectations for growth on earnings, at the beginning of the year, they were at 11.5%. Now they're expected to grow at 7.3%, right? So analysts are bringing those expectations down. And a lot of this has to do with the uncertainty around tariffs, which are starting to affect kind of economic growth. The other data point that we saw was payrolls came in at 151,000 in February, just slightly below the 159 that was expected. The unemployment rate did tick up to 4.1%. A pretty boring report that calmed the markets a bit in the sense that, yes, the employment picture is slowing down, but is not at levels yet of a concern, right, of a recession. So that's really what the market's trying to digest. Is this a slowdown and just therefore a market correction, or is this the early signs of the economic data showing signs that it's heading into a recession? For now, the market is still trying to figure it out. As I always say for these things, right? If you're investing for the long term, just keep rebalancing, do tax loss harvesting, use this as opportunity to rebalance your portfolio. Don't make long-term decisions based on a lot of the noise that happens week to week. That is it for this week. Stay tuned for next week.